This is the Professional Edge. My name is Sean Todd, tax attorney, CPA, and certified financial planner. Host here on the Professional Edge for north of 5 years. We're talking about being a conservative investor 411. And what does that actually mean? Well, what's the information I need to know as a conservative investor to protect my portfolio to have that safe and secure retirement? Well, here's the instrument you can use. You can use a CD, a certificate of deposit. It's FDIC insured. But you know what? The Fed just dropped rates 25 basis points. So your reinvestment risk, your renewal time is coming up in November, December. That's the majority of when CDs mature. And your renewal rate is going to be in that 3 to 4% range. I'm not sure you want to commit to a 4% rate for 5 years because that will lock in that amount for that period of time. So you're probably in that 3.5% range for a 1-year CD. So that may not be what you want to do because there is no renewal for a 5.5% CD going forward. So what do you need to do? That's an alternative. You can renew at that 3.5%. Going to pay tax on it if it's in your after-tax account. And when you get all said and done, you're probably at a 2% rate of return. Inflation is 3+%. So you're losing purchasing power safely with that renewal CD. So let's see what an alternative is. Well, to protect your principal, that's what a lot of individuals who invest in CDs are worried about. They don't want to lose their investment capital. So what's another avenue to do that? Well, we can do a fixed annuity. That is a contract with an insurance company. It's not FDIC insured. It is based on the claims paying ability of that insurance company. Now, again, we can enter into that contract with the insurance company. And it says you deposit your dollars and we will pay you a fixed rate of return. And you can have a maturity date of, let's say, 3 years, 5 years, 7 years. And they're going to pay you that fixed rate of interest as defined in the contract. Again, the contract is between you and the insurance company. You can shop this and have it mature at different times. So you can have, quote, this rolling annuity plan, and that protects your principal. Again, it's based on the claims paying ability of the insurance company. So you would definitely want to place your dollars with a, highly rated, financially secure insurance company, top shelf brands. So that's another way to protect your principal 100% from downside risk. Okay, so that's a fixed rate of return. But listeners here on the Professional Edge, they want a better rate of return than a fixed rate of return on a CD at 3% or a fixed annuity return, let's say 3.5%, 4%, because insurance companies, they pay a little bit more because they're, quote, a little bit more risky than an FDIC insured CD. So next vehicle we could use on a conservative investor 411 would be what is known as a fixed indexed annuity. Now, again, it's a contract with the insurance company based on the claims paying ability of that insurance company. And with that, fixed means your capital is 100% protected. Then what about this index annuity part? Well, the index is based on the S&P 500 index or another like Russell 2000 index, a very common stock index. And it basically says there are moving parts within these. So we can have a participation rate. So let's say it's an 80% participation rate with no cap. So that definition would be if the market went up 10%, the insurance company would pay you 80% of that. That's what means by the participation rate. So S&P 500 index goes up that 10%, your participation rate is 80%, so you would be credited 8% rate of return. So now your account value is at 108. Now, If the market has a correction the following year, your 108 is protected. So you're protected from downside risk. So it locks in your gains. Now, this is substantially different from a portfolio of stocks, bonds, and mutual funds because your capital is not protected from downside risk. So that's an advantage on a fixed indexed annuity. It protects your principal and it locks in your gains. Now, the downside is that you only are going to participate 80% in my example on the upside. So if the market goes up 20%, you only get 80% of the 20%. That would be 16%. So you give up the upside full potential of a market rate of return. But for giving up that small 20%, then you're protected from the downside risk. Now, within fixed index annuities, there are other moving parts. It may say you get 100% participation, but you are capped at your gain. So you could have 100% participation, but you are capped at 15%. So if the market returned 8%, you would get all 8%. If the market returns 17%, you would get all of 15%. You would leave the 2% on the table. If the market returned 25%, then you would only get 15%, that cap rate. So that's another way that this fixed index annuity could credit you towards your gains. Now, inside there are also other moving parts. There are fees, costs, and expenses within fixed index annuities, varying from insurance companies. Now, being licensed to sell fixed index annuities, we have to do a very due diligence on these because they are a complicated product. It is not the magic bullet for conservative investors. It's something to consider being a conservative investor to lock in some of your investment capital. Majority of time, what we do is try and put it in what I call the back of the barn money. Growing up on a farm in Indiana, baling hay and milking cows, it's called back of the hay money. So, or back of the barn hay money. So when we look at that, we say, all right, you got $1 million inside an IRA. Let's position $200,000 in this fixed index annuity. It has a surrender charge of 9 years. So therefore, if we liquidate it before 9 years, we're going to pay a penalty. Well, if the back of the barn money is the last money we're going to use, that's okay. The surrender charge should not have any impact whatsoever because we plan on holding this for 10 years. Now, over the course in time, an expectation of return could be anywhere from 6 to 8%. That is the rate of return you should expect for this money. Now, for the back of the barn money, 6 to 8% with no downside risk, we lock in our gains. That's not all bad. So, to have that conversation on whether a fixed index annuity actually works for you in your portfolio as a conservative investor, do give our office a call at 404-250-9798. That number again, 404-250-9798. Now, again, I want to reiterate, they are complicated products. When this comes out, it's a contract probably north of 100 pages. So if you're considering this from an insurance salesman, and that's what they are, they're selling insurance, not a registered investment advisor. They're not a tax attorney, they're not a CPA, and they're not a certified financial planner. So if you're being hawked by an insurance salesman, just pump the brakes, hold on a second, get a second opinion. So to get that second opinion, give our office a call at 404-250-9798. That number again, 404-250-9798. Now, being in the business close to 25 plus years, I've seen the good, bad, and the ugly from these because they may have some free surrenders or free withdrawals as they call it. And they say, okay, you can take 10% of what you have in there. Now, okay, I invest $100,000 has grown to, let's say $150,000 over the course of time, and you want your free withdrawal. Well, you're thinking it's 10% of the 150,000. Within the contract terms, it may actually limit it to 10% of the original contribution into the contract. So again, being a tax attorney, you got to look at the fine print to make sure you understand the liquidity events, meaning is it 10% of the accumulated value or is it 10% of my original investment? So that's where the terms get complicated, and you, being a listener here on the Professional Edge, don't know or you are not aware of what to look for inside these contracts. And again, I cannot reiterate as much as possible, you have to understand what you're getting into. The other sort of downside that I've seen on these fixed index annuities is that the insurance company can actually change the terms or the crediting of the amount after the first year. So they can say, the way we're going to calculate what you're credited actually gets adjusted after year one. So inside these fixed index annuities, you're only guaranteed contractually what that first year stated rate and crediting is. Because within the provisions, then it says we can adjust or amend our crediting terms or cap what we do. So it changes the deal, and that's why you got to be very suspect on these. If you're okay with protecting your principal and you're okay with a modest rate of return, this might make sense for you within your portfolio. It's not a blanket silver bullet of, hey, I'm going to protect my principal. I'm going to participate in the market when it goes up and never when it goes down. My gains get locked in. My goodness, I need to put 80% of my retirement investments in this account. It sounds so good, but we all know the adage, if it's too good to be true, it probably is. So again, if you're considering this or you've been hawked, you went to a dinner and they explain this, now the new terminology is a hybrid. We have a hybrid investment. Well, if you hear the word hybrid, pump the brakes, stop, get the information, give our office a call at 404-250-9798. That number again, 404-250-9798. Let's have a conversation to make sure you understand what actually you are thinking about putting inside your portfolio. My name's Sean Todd, tax attorney, CPA, and certified financial planner, host here on the Professional Edge. I appreciate you listening in, and stay tuned for more.
We've all thought about it. Everyone listening will need one. Not having one can cause untold heartache, family conflict escalating to the point of a lawsuit. One simple thing that avoids all that: an effective estate plan. As a practicing tax attorney, Sean Todd with Estate Management Counselors has completed over 1,000 estate plans during his 15 years of professional practice. He can help you implement an effective estate plan, coordinate your financial accounts, and make sure you have named the proper beneficiaries to maximize your tax savings. Call 877-654-9798 today and let tax attorney Sean Todd help you implement an effective estate plan. Call 877-654-9798 today. As a tax attorney, CPA for over 15 years, Sean Todd has implemented over 1,000 individual estate plans. He has recently authored an especially helpful guide, How to Unlock the Ultimate Estate Plan. This guide has helped many individuals to understand the benefits of an estate plan and how to avoid unintended disasters. Sean has made every attempt to write this in plain English. To receive this valuable guide, How to Unlock the Ultimate Estate Plan, call 1-877-654-9798 and request your complimentary copy today, or by emailing your request to info@emcadvisors.net.